You do everything you're supposed to. You diligently, almost religiously, save €200 every single month. You watch the number in your savings account tick up, and for a fleeting moment, you feel a sense of pride, of security. But then you walk outside your front door. You look at your life and realize you're stuck in the same place. Your savings go up, but so does your rent. So do your groceries. So does the price of a simple coffee with a friend. It feels like you're running on a financial treadmill, putting in all the effort, but going absolutely nowhere. You're doing the responsible thing, the thing you were told was the key to a good life. But what if I told you that the advice to just save your money is the biggest, most destructive financial lie you still believe? What if I told you that the very act you think is building your security is actually making you poorer day by day? That your €200 a month isn't building a fortress. It's just sitting in a bucket with a hole in it, silently leaking value. In the next few minutes, I'm not just going to call out this lie. I'm going to show you exactly why it's a lie, using simple, undeniable math. And then I'll reveal the one crucial step you're missing, the step the wealthy have used for decades to not just protect their money, but to make their money work for them. This is the secret that separates those who tread water for life from those who build real, lasting financial freedom. Now, if you believe this lie, I need you to hear me loud and clear. It is not your fault. This idea has been drilled into us since we were kids. It started with a piggy bank. Your parents gave you a coin for a chore, and you'd hear that satisfying clink as you dropped it inside. The lesson was simple. Collect money. Keep it safe. Don't spend it all. Then came school. In the rare moments finance was even brought up, it was all about budgeting and saving. A penny saved is a penny earned. You were taught to be frugal, to cut back, to save, save, save. Finally, you became an adult and opened your first bank account. And what did the bank do? It celebrated your savings. It offered you a high-yield savings account, telling you it was the smart, safe, responsible place for your hard-earned cash. They even give you a little bit of interest, just enough to make you feel like you're getting ahead. This belief that saving money equals security is comforting. It feels controllable. In a world of economic uncertainty, with shaky job markets and scary headlines, putting money aside feels like you're taking back control. It's a low-risk action that gives you a sense of safety. You put €200 in. You know that in a year, you'll still have that €200, plus a little extra. No scary red arrows pointing down. It's predictable. It's safe. But here's the uncomfortable truth they don't print in the brochure. You were programmed with financial advice from a world that doesn't exist anymore. The playbook your parents used is dangerously outdated today. Let's pull back the curtain and look at this from the us versus them perspective that the wealthy understand so well. Why is the save your money mantra pushed so hard by banks? It's simple. It benefits them. When you deposit your money into a savings account, the bank doesn't just let it sit in a vault. They take your €200 and lend it out to other people for mortgages, car loans, and business loans at a much, much higher interest rate. They might pay you 3% on your savings, but they're earning 7% on a mortgage or 12% on a personal loan with that exact same money. They are using your capital to generate massive profits for themselves, and they're giving you a tiny fraction of the earnings as a thank you. You are taking on all the risk of your money losing value over time, while they reap the rewards of its growth potential. They want you to be a saver. A population of savers provides banks with a massive, cheap pool of capital to power their profit engine. The lie persists because it's incredibly profitable, just not for you. So, if you're doing the right thing by saving, why does it feel like you're getting poorer? Why can that €200 you saved this month buy less than the €200 you saved last year? The answer is the real villain of this story, a force working against you 24/7, even while you sleep. It's an invisible thief that systematically steals the value of your money. Its name is inflation. You've heard the word, but the financial world loves to make it sound complicated. It's not. Think of it like this. Inflation is a silent tax on your cash. It's a slow, steady leak in your savings bucket. Every year, the prices of the things you actually buy, rent, food, electricity, transportation, tend to go up. That means each one of your euros can buy less stuff. Let's make this painfully real. While the European Central Bank aims for 2% inflation, Recent data from late 2025 and early 2026 shows it fluctuating, with figures around 2.0% to 2.5% and sometimes higher. Let's use a conservative average of 2.2% for our example. That might not sound like much, but it's a corrosive force. If you have 10,000 euros sitting in a regular bank account earning nothing, after 1 year of 2.2% inflation, your 10,000 euros can now only buy what 9,780 euros could buy a year ago. You haven't spent a single cent, but you've lost 220 euros in purchasing power. It just vanished. Over time, this is devastating. That same 10,000 euros, after just 10 years of 2.2% inflation, would only have the purchasing power of about 8,045 euros in today's money. You've lost nearly 20% of your savings just by saving it. This isn't a theory. It's why you feel the squeeze. It's why you see your grocery bill for the same items creep up. You saved 200 euros, but the cost of your life goes up by 250 euros. You are literally moving backward. Now, you might be thinking, okay, but I'm smart. I don't use a 0% account. I use a high-yield savings account. That's the next layer of the lie. As of early 2026, amid ECB rate cuts, you can find high-yield savings accounts, HYSAs, in Europe from brokers and digital banks offering around 2.5% to 3.5%. On the surface, that sounds like a solution. If inflation is 2.2% and you're earning 3.5%, you're winning, right? You're making a real return of 1.3%. Let's be generous and do the math on that best-case savings scenario. You diligently save 200 euros every single month in a HYSA, earning a steady 3.5% APY. After 10 years, you will have contributed 24,000 euros. With interest, your account will have grown to about 28,700 euros. Not bad. After 20 years, you will have contributed 48,000 euros. Your balance will be around 69,300 euros. That feels substantial. It feels like security. But this is a mirage. We have to account for the silent thief. We have to adjust for that 2.2% inflation. That 28,700 euros you have after 10 years, in terms of what it can actually buy, its real purchasing power is only about 23,085 euros in today's money. You put in 24,000 euros of your hard work over a decade, and in real terms, you've actually lost almost 1,000 euros worth of buying power. You went backward. And the 20-year figure? That impressive sounding 69,300 euros? After 20 years of inflation, its purchasing power is only about 44,850 euros. You contributed 48,000 euros of your own money and ended up with less value than you put in. This is the cold, hard reality of saving alone. You are playing a game that is rigged against you. You are fighting a battle with a pea shooter against an opponent with a tank. You are diligently filling a bucket that is guaranteed to leak faster than you can fill it over the long term. This is the moment you should realize the system you trusted is failing you. Before we get to the solution that breaks you out of this trap, I have a question for you. What's the worst piece of financial advice you've ever received? Was it from a parent, a teacher, a so-called guru? Let me know in the comments below. I read every single one. And if you're finally having that aha moment about your money, do me a favor and tap that like button. It tells the algorithm that this is a message people need to hear. So, if saving is a losing game, what's the move? Give up and spend every euro you make? No. The real answer lies in a mindset shift, moving from being a saver to being an owner. The wealthy have known this for generations. They know that money in a savings account isn't for building wealth. It's for emergencies. It's for short-term security. The money that actually builds your freedom, your future, that money needs to be put to work. That money must be invested. Investing isn't some scary, complicated thing reserved for Wall Street suits. At its core, investing is just using your money to buy assets, things that can grow in value or generate income over time. It's becoming an owner, not just a saver. You're buying a tiny piece of a successful company, a small slice of the global economy's growth. Let's break down the huge difference between saving and investing. Your HYSA has one goal: preserve your capital. Its risk is super low, and because of that, its return is also very low, barely beating inflation if you're lucky. It's designed for short-term needs, like a buffer for the next 0 to 5 years. Investing has a totally different goal: to grow your wealth. The risk is higher because you're exposed to market swings, but the potential for returns is dramatically greater. Historically, a broad basket of stocks like a global index has returned an average of 9 to 10% per year over the long run. This isn't just one good year, this is the average over decades, including all the crashes and recessions. It is your single best weapon against inflation, and it's designed for long-term goals, anything 5 or more years away. Let's go back to our story of two people. They're identical in every way. Same job, same salary, same desire for a better future. Both commit to putting aside 200 euros every month. Person A is the saver. They do what they were taught. They put their 200 euros every month into that best case HYSA, earning 3.5%. They feel secure, but as we just saw, they're slowly getting poorer. Person B is the investor. They do something different. They first build a safety net, an emergency fund in a HYSA. But once that's full, they take that same 200 euros a month and start investing it in a simple, low-cost fund that tracks the global stock market, aiming for that historical average return of 9%. Let's see where they end up. After 10 years, person A, the saver, has their 28,700 euros. Person B, the investor, has 38,500 euros. That's almost 10,000 euros more from the exact same monthly effort. Now let's look 20 years down the line. This is where the magic of compounding really kicks in. After 20 years, person A, the saver, has their 69,300 euros. Person B, the investor, has 133,800 euros. This is not a typo. By making one different choice, person B has nearly double the money. They are in a completely different financial universe. And remember our inflation-adjusted numbers? That 133,800 euros has the real purchasing power of about 86,500 euros in today's money. It's a massive, life-changing real gain. Person A has less buying power than they put in. Person B has dramatically increased their real wealth. This is the power of shifting from a saver's mindset to an investor's. Now the big question, the fear that holds everyone back. But isn't investing risky? What about a market crash? I could lose everything. Yes, investing has risk. The value of your investments will go up and down. There will be scary headlines. That's part of the deal. The higher returns you get from investing are your reward for taking on this short-term volatility. But there are two powerful ways to manage this risk. First, your time horizon. Investing is a long-term game. If you won't need the money for at least 5 to 10 years, you have time to ride out the downturns. The market has always recovered from every single crash in history and gone on to reach new highs. For instance, the market took a big hit in 2022, but by 2024 and 2025, it had already rewarded those who stayed the course. Second, diversification. You don't put all your eggs in one basket by trying to pick the next hot stock. That's gambling. Instead, you buy a small piece of everything. Through something called a low-cost index fund, or ETF, you can own a tiny slice of thousands of the world's biggest companies with a single click. If one company tanks, it barely makes a dent in your portfolio. You are betting on the long-term growth of the global economy. The lie isn't that saving is bad. The lie is that saving is enough. Saving is step 1. Investing is step 2. And you can never win without step 2. Okay, this all makes sense. But how do you actually do it? Here is your simple 3-step plan. It doesn't require a finance degree. It just requires a decision and automation. Step 1. Save smart. Build your emergency fund. Before you invest a single euro, you need a safety net. This is what savings are actually for. Your goal is to save 3 to 6 months of essential living expenses. Calculate what you need to survive. Rent, utilities, food, and multiply it. This money protects you from job loss or unexpected emergencies. It's what allows you to invest with confidence, knowing you won't have to sell at a bad time to cover a crisis. Where to put it? A high-yield savings account. HYSA. Don't leave it in a standard checking account. Look at platforms available in Europe like Trade Republic or Scalable Capital, which currently offer competitive rates. Make sure your choice is covered by deposit protection. usually up to 100,000 euros in the EU. How to do it? Automate it. Set up an automatic transfer from your main account to your HYSA for a fixed amount each month. The day after you get paid, pay yourself first, for security. Step 2. Invest consistently. Build your future. Once your emergency fund is full, it's time to build wealth. You keep saving your 200 euros a month, but now that money gets a new job. It goes into your investment account. Start small. You don't need a fortune. You can start with just 50 euros a month. The key is building the habit. What to invest in? For 99% of people, the best answer is a low-cost, broadly diversified exchange-traded fund, ETF. A fantastic, simple option for European investors is a world-tracking ETF, like the Vanguard FTSE All-World, ticker VWCE, or an iShares MSCI World ETF. These funds give you a piece of thousands of companies across the globe for an incredibly low fee. VWCE's is just 0.22% per year. How to invest? It's as easy as using an app. Use a low-cost European broker like DEGIRO, Trade Republic, or Scalable Capital. These platforms are designed for beginners and let you open an account in minutes. Step 3. Automate your wealth machine. This is the most critical step. Don't rely on willpower. Inside your brokerage app, set up an automatic savings plan or recurring investment. Tell it to take 100 euros, 200 euros, or whatever you can afford from your bank account every month, and automatically buy your chosen ETF. Set it and forget it. This removes emotion from the game. You won't panic when the market is down or get greedy when it's up. You are just systematically buying, month after month, year after year. This strategy is called dollar cost averaging, and it is the most proven path to building wealth for regular people. That's it. That's the whole secret. Build a safety net, then automate your investments into a simple, diversified fund. It's not glamorous. It's not a get-rich-quick scheme. It is a simple, powerful, get-rich-slowly but surely system that actually works. Conclusion. For your entire life, you've been told a story about money, a story where the hero is the diligent saver, building a fortress of cash, brick by brick. But that story is a lie. The lie isn't that saving is bad. Saving is vital. It's the foundation of your financial house. It's the moat around your castle that protects you from the dragons of unexpected bills and job loss. But a moat and a foundation are not the castle itself. The biggest money lie is that saving is enough. It's that step 1 is the only step. If you stop there, you will run on that financial treadmill for the rest of your life, working harder only to find yourself falling further behind. You'll feel secure, but you will never be free. True financial freedom isn't just about protecting what you have. It's about growing what you have. It's about making your money work for you as hard as you work to earn it. It's about owning a piece of the world's growth, not just watching from the sidelines. Saving protects your present. Investing builds your future. So I want you to make a new choice today. Keep putting that 200 euros aside, but give it a new mission. First, build your shield, your emergency fund. Then, start building your engine for wealth. Start investing. Start with 50 euros a month if you have to. The amount doesn't matter as much as the action. Start investing the difference and watch that 200 euros a month transform over time from a symbol of your financial anxiety into your freedom fund. If this video flipped a switch in your brain, do 2 things for me. First, subscribe and hit the notification bell. We're on a mission to dismantle every money lie they taught us. Second, share this video with one person you know who is doing everything right but still feels stuck. Your path to real financial freedom starts now, and it starts with the truth.